Moderna just ran 33.5% in 5 days, but the event everyone's pointing to wasn't the real decision. Here's how to think about option premium when a stock runs into a catalyst that hasn't happened yet. What's up, guys? Coach B here. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy Moderna calls, puts, or anything else, and I'm definitely not predicting what the FDA does. What I want to do is use this real life setup to teach you something that trips up a lot of beginners, the difference between a stock reacting to news and a stock pricing and a decision that's still weeks away. So let's look at the actual chart. Zoom back a few weeks and Moderna was trading around $49 on June 3rd. It has climbed the whole way up since then. But the number everybody's quoting is the last stretch. Just 5 trading days ago on June 25th, it closed at $59.75. And by July 2nd, it closed at $79.76. That's the 33.5% move over 5 sessions everybody's talking about. And just look at that last candle alone, up about 8% in a single day on July 2nd. Something real is happening here. The question is what? 3 things stacked up. On June 18th, an FDA advisory committee voted 9-0 that Moderna's flu vaccine, MF-Luciva, has a favorable benefit-risk profile for adults 50 and up. Then around Moderna's Science Day, basically a pipeline reveal for investors, the stock jumped almost 13% in the June 26th session alone. And right after that, Piper Sandler raised their price target from $69 to $77. 3 bullish headlines, one direction. Straight up. Now, here's the part I actually want you to slow down on, because this is the whole lesson. That 9-0 vote on June 18th was an advisory committee. Advisory committees recommend. They do not approve drugs. The FDA usually follows their advisory panels, but it isn't required to, and it hasn't actually made the call yet. The real decision, the PDUFO date, the actual up or down on this vaccine is August 5th. That's still weeks out from where we're standing. So think about what just happened. The stock ran 33% into an event that, by design, didn't actually decide anything. It's a strong signal. Sure, the panel doesn't vote 9-0 for nothing, but the binding decision is still ahead of us. And that's exactly the setup where options get expensive, because the market has to price in a real binary event that hasn't happened yet. Let's pull up the actual chain so you can see it, not just hear me describe it. Looking at the July 31st expiration, 28 days out, the at-the-money strike is 80, right around where the stock's trading. The 80 call is going for about $8, and the 80 put is going for about $8.10. Notice the implied volatility on both sides. It's sitting up near 95 to 97%. For context, a normal stock might run implied vol in the 30s or 40s. This is nearly triple that, because the market knows there's a real catalyst still coming, and it's pricing that uncertainty into every single option on the chain. Here's how you actually use that number as a beginner. If you add the call and the put together at that 80 strike, you're looking at roughly $16.10 in combined premium on a stock trading at $79.76. That's the market telling you it expects a move of somewhere around 20% up or down before that expiration. That's the implied move. It's not a prediction of direction. It's the market's price tag on uncertainty. And this is where beginners get hurt without even being wrong about the stock. Let's say you buy that 80 call for $8 because you think Moderna keeps climbing into the actual approval. Say the news comes out fine, the stock even ticks up a little. But because that huge chunk of the options price was pure implied volatility, not the stock move itself, the IV can collapse the moment there's clarity, even good clarity, and take a big bite out of your options value on the way down. You can be right on the headline and still lose money on the contract. That's the trap. So how would I actually think about a setup like this if I wanted exposure at all? Not buying a single naked call and hoping IV stays rich. I'd look at a defined risk structure, something like a debit spread, buying the 80 call and selling a call further out, say the 90. Here's the actual math on that, not just the concept. The 80 call is asking $8.95. The 90 call you're selling is bidding $4.40. You buy the 80 and sell the 90, so you pay about $4.55 for the spread, and that $4.55 is the most you can lose. Full stop. The strikes are $10 apart, so the most you can make is capped around $5.45. The width minus what you paid. Smaller potential win than a naked call, but you know exactly what you can lose before you ever place the trade. And there's a real downside scenario here too. If Moderna just goes sideways for the next few weeks into that August 5th date, both the call and the put lose value every single day from time decay on top of whatever IV does. Premium sellers like that kind of chop. Premium buyers get ground down by it. That's the risk you're taking on either side of this trade, and there's always risk in everything. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell Moderna or anything else. Do your own research and know your own risk tolerance before you put any trade on. I'm also not predicting what the FDA decides on August 5th. Nobody actually knows that yet, including the people trading this stock right now. So that's the lesson. When a stock runs hard into a known dated catalyst that isn't actually the final decision, options premium gets expensive because the market's pricing in a move that hasn't happened yet. Know the difference between the headline event and the real binary. Check the implied move before you buy anything, and think in defined risk, not naked bets. Subscribe, and I'll break down the next FDA catalyst setup like this one. Drop your questions in the comments. Good luck in the markets, no matter what stock you're into.